Is this a dream?
No, it's not a dream. I'm an angel.
Why would God send me an angel?
Because God knows that everyone needs a little coaching now and then.
I'm loving angels.
I saw an angel.
All angels say, follow me. You sent me an angel. The smile on her face.
Be in it together, but don't hold me, angel.
Been touched by an angel, girl.
Hi, and welcome to the Super Angel Podcast, the go-to podcast for angels backing the next generation of European unicorn founders. If you love our show, do drop us a review, share it with your friends, and join our community at EU.VC. Dan is the GM International at Public.com, the US-based investing platform where members can build a modern portfolio of stocks, ETFs, crypto, collectibles, and more. In his role, Dan oversees the platform's expansion into new markets. Prior, Dan was the head of expansion at Wise, and currently he's an active angel investor, mainly in early-stage FinTech. The insights shared on angel investing are not a reflection of the guest employer, Public.com, and this is not financial advice. If you're an angel listening in and wanting to get closer to the European angel scene, do not hesitate to reach out to us. We'd love to connect and see how we can play together. And now, some words from our beloved sponsor. Vaban from Carter is the easiest way to launch and run your syndicate. Vaban's end-to-end platform automates your back office so you can focus on what matters, supporting the next generation of entrepreneurs and building your network. Angel investors are the fuel to innovation, and they've created the Atom SPV to allow for more deals, more ownership, and less fees. Backed by Carter, the leading fintech infrastructure company, Vaban will be with you all from fundraising to exit. Investors on the Vaban platform have raised over $2.5 billion in global investment for companies including Revolut, Bolt, and SpaceX. If you'd like to learn more, please check out www.vaban.io/EUVC.
Dan, welcome to the Super Angel Podcast. We're so excited to have you with us.
Thank you for having me. I'm really excited about this.
Thanks for joining the pod, Dan. I'm really excited to get started, actually. You've held position very interesting companies, right? Wise, now Public. Can you share with the listeners your story and what got you into angel investing?
Yeah, sure. I think there are almost like two stories that eventually sort of converge at the top. So let's begin with sort of my personal or professional journey. Currently, I'm the GM International at Public.com, relatively well known in the industry as a US-based investment platform offering everything from stocks, ETFs, collectibles, and crypto as well. And I'm the GM International there, which means that I overlook the company's strategy to grow and expand into new markets. So a lot of my role actually feeds back into go-to-market or ops and very much of the strategy that comes with that. Prior to that, I was at a very well-known European fintech called Wise, or formerly TransferWise, and had a super exciting role there actually, which I really enjoyed, which was Wise is historically known as just a sort of payments and remittance or FX and remittance company. But the interesting thing about Wise is that over the years, it has evolved, offering multi-currency accounts, business accounts, and recently launched a few years ago now, an assets product. So for customers that had money held in cash there, how do you help them invest it or help it grow? And so we launched an assets product there. And when I joined, it was very much so this very impressive, again, cross-border payments company, but looking to add new financial services. So I was the head of expansion for assets there, which was a fantastic experience. And prior to that is probably actually where my fintech journey sort of started. So prior to Wise, I was a founder within Founders Factory, so relatively well-known accelerator in London. Sort of throughout that journey of being a founder and being within the Founders Factory ecosystem, it afforded me the chance and opportunity to meet a lot of interesting people within the space, to really immerse myself, to meet people at late-stage companies and early-stage companies and everything in between. And that was, I think, really my sort of like step into the world of fintech, and haven't looked back since. But before that, actually, like a lot of people in fintech, actually, I started in the world of traditional financial services on the trade floor, actually, at Citigroup, which I also enjoyed, but I did feel this very strong draw towards the world of fintech simply because, especially in the last 5 or 7 years, so much change, so much impact, so much room to grow. And so like a lot of people made the transition into fintech. A little bit about me. So how does this lead into angel investing? I'd say, so angel investing to me is something that has sort of happened in the last, I'd say 2 years. But my journey is like a very intentional one, but also a very unintentional one. Intentional in the sense that I've always been very open about meeting with new people, trying to connect with people in the industry that are doing exciting things, that are passionate about what they're doing, that they're energetic about it. And I think that's allowed myself to open up my network, to meet people, sometimes even to help them or to lend a hand however I can. And so that was sort of very intentional. I always really enjoy that. And I always try and find time to do those things. Unintentional was like, when did I actually cross the line into being an angel investor? And I was thinking about it on this call. It was actually when first company, I made a few sort of small investments, and it was maybe vehicles or groups or syndicates. But the first sort of like real angel investment that I made was this company called Orbit, basically like a software tool to collect for customer discovery. So if you're collecting feedback, data, etc., on a given customer, it's a more sort of organized and granular way to collect feedback, which then informs product and design decisions, etc. And how I actually got into that is I met the founding team, Ben, and it started as more of a conversation a bit about, hey, this is what we're building. And I thought, I've seen this all the time, whether it's in small startups or larger companies where collecting customer feedback is so important. And there are different tools, and there are spreadsheets, and there are notepads and Google Docs, et cetera, et cetera, et cetera. And so as I was walking through the demo, I thought, this is great. Like I've sort of like seen this problem and I've seen this play out. And one thing led to the next. And that was my first angel check, and actually managed to even bring some people that had design and engineering backgrounds as well that I had worked with, who also saw this and saw, well, this is a problem worth solving. And so it's something that I've always wanted to do again, but how it started was a little bit sort of serendipitous. Yeah. Conversations that led to an opportunity, and then been much more active since, and I've really enjoyed it.
Yeah, we've heard that from a lot of people, like in kind of your position, right? It tends to happen organically, right? You help people, and you want to align with that on the upside as well. And at some point you cross the chasm without even knowing, which is really cool.
That was exactly it.
2 years in, I guess, looking back, any other memorable deals or any recent investments you want to share with the listeners?
Yeah. So I'd say, like, as a recap, probably made 12 to, I'd say, 15 investments, mainly FinTech. I think that's not because I think FinTech is the only sector with opportunities, but just the nature of my work and my network, and sort of it tends to just feel more organic because of the quality of, I'm able to identify opportunities a little bit faster. More comes in naturally through my network, etc., which I'm sure you hear from other angels. And so a few memorable ones. So I guess across this 12 to 15, it's really been, in terms of spread, I'd say very early stage, relatively distributed geographically. I'd say UK, Europe. I live in Amsterdam, so also one or two deals here in the Netherlands, also in Israel as well. So kind of further out in the sort of EMEA bucket, if you will. In terms of like memories, actually, so Anthony, I have an interesting one. This is maybe one of the, again, we talk about sort of you evolve in your angel journey, and this was a sort of like step forward. Is I won't say the name of the startup that this was, but basically a long story short is it was a company that I really identified as, okay, I wanted to take part of this deal, and it was really interesting, and I saw it was really aligned with the founders and felt like this was great. The only problem is the deal was moving very quickly. Different lead investors were coming in, and so terms were kind of changing. As an angel investor, you don't have as much of a say into these things, especially as rounds get larger. And I remember chatting with you, Anthony, and you said, it's okay to be a little bit uncomfortable. And I think that's like something that I remember with angel investing, is that I say, at the end of the day, these are very exciting, but early stage, risky propositions. There are times where, as an angel investor, rounds are moving at a more normal pace, sometimes at a faster pace. Sometimes you see a lot of things that you absolutely love about the business. Sometimes you see quirks that you're not quite comfortable with. And so somewhere along that journey, there have been a lot of exciting moments, and I've really enjoyed all of it. But one of the key learnings, or one of the parts that I'll really remember, is I think that conversation we had, where it's actually, it's okay to be a little bit uncomfortable. And sometimes the best deals are one where you're a little bit uncomfortable, but you're kind of like leaning into that risk. And I think that's the nature of the game as well.
Like, also reflecting back, the best deals in retrospect that, I've done to date have been ones that I've been slightly uncomfortable, right? Because usually there's like competition and things dynamically change, and then maybe you stretch a bit more on valuation, and but it's the nature of the fact that it's usually a very hot deal for a reason, and you're very excited about it. When you end up doing it as well, means that you're excited enough to make that compromise.
I'm curious to ask both of you on that a little bit, because I'm sure that we'll have people listening in thinking, uncomfortable on what parameters? Is it in terms of the deal speed, or is it in terms of, now you mentioned valuation, maybe that's seems a little too high?
I would say everyone is different, right? Everyone has different sensitivities. If the deal is moving faster than you're used to, It might be because, deals you've done in the past, maybe we're at a more normal cadence. So now having to review docs, feel comfortable, maybe open up your spreadsheet and see like, okay, what does a payout look like? Maybe you're doing that at a faster pace and you feel a little less confident because it's your first time. For some people, it might be the check size. So it might be, hey, this is really outside my sweet spot. This is maybe an outsized risk for me. Again, that comes down to someone's personal circumstances. But I think different parts of the deal may look differently to different people. I think there's no one answer to your question, maybe.
If we were to take valuation, though, as an example, I'll say the opposite. Like, obviously, valuation matters. It can be a mental trap if it's a, 10 billion, 50 billion outcome. But generally speaking, I think discipline matters. The opposite to what we're saying actually is interesting. If I've caught myself consistently being critical of a valuation of a company, means I'm probably not excited about it, right? If I'm like, constantly hooking on the like, yeah, but it's like, 20 million or 15 million and I'm not sure of the valuation, it means I'm not excited enough about the upside potential, the opportunity. That doesn't mean that you should be doing anything and everything and no matter the valuation. That's not what I'm saying. It's just like the inverse of what we're saying is that like, if you catch yourself being overly critical about the parameter of a deal and that being potentially a deal breaker, it also probably means you're not excited enough to back the founder and the opportunity as well, right? So it's also the other way around.
It's almost like if there's a certain so-called variable and you're a bit uncomfortable with that, but you're still thinking, oh, I really want to be a part of this journey. I really want to land on this cap table. I think this is like a really good fit for my angel portfolio. And I actually think I can work really well if I need to and contribute somehow to the founding team. If almost like that risk that's at the top of your mind keeps being offset by all the positive things, that probably means you really want it and you really want to be on that cap table. So again, it's okay to be a little bit uncomfortable. But I think, again, being a little bit uncomfortable, being equally excited about a deal is maybe sometimes a good sign. I think that was the conversation Anthony and I had a year ago now.
Yeah.
But I've always viewed that as a bit of a turning point in my approach to angel investing.
First of all, Anthony, that's a big kudos, right? There's nothing better than to hear from someone you respect that something you said at some point actually meant something to them.
Coach Anthony, there you go.
I love that.
It means a lot.
We spoke a bit about valuations there, and I got a text earlier this week from an angel asking me, I wonder, maybe you've got some data on this, and then what he wanted to check was data on kind of the evolution of valuations and specific space over the last couple of years, because he wanted to, bolster his arguments towards a founding team in terms of bringing the valuation down, because they were a bit not on the same page there.
Got it.
I'm curious to hear your take on that, because my first reaction was, so I said to him, well, why don't, if you don't think that the price is right and they don't buy your arguments, well, then it's maybe not the right thing, right? But I'd be curious, what is your take on that? Because that whole thought of arguing with objective facts, a bit to me is kind of going down a rabbit hole, or at least it seems a bit like you're educating someone on something that you shouldn't necessarily be educating them on. But I'd love to hear your take.
I think in terms of when we look at, again, so let's talk early stage investing. Sometimes these are very small teams. Sometimes they have a product in market. Often they maybe don't even have a product in market yet. I kind of struggle to put labels on these things as, is something too high, too low? Is it right? Is it wrong? Simply because I think as an angel investor, you are likely leaning into two things. One, that you think the founding team is, and we could talk about investment approach separately, but one, they think the founding team is able to execute on their vision. And two, that they're surrounded by the appropriate people. So if a lead investor comes in and sets a certain price tag, usually that means it's a result of maybe the market conditions, maybe other peers in the industry. And as an angel investor, I try not to overthink those. I try and digest that information and consider it and make sure I'm comfortable with it. It still is an investment. But also I think as an angel investor, you're almost always leaning or cozying up to whatever terms have been agreed between the founding team and the lead VCs that are in place. So I always take a look at it, and price does matter in early stage deals. Valuations do matter. But also I think as an angel investor, maybe opinions aren't as strong on that topic in my view.
Oh no, not about the thesis.
Could you just give us an overview? You've already said that, you've done 12 to 15 investments and they've been graphically distributed, but I'd love to hear you unpack a bit, and then also the vertical in being primarily FinTech. But I'd love you to put some more words to that.
If I were to sort of dive into my investment approach, there are, like anything, right? So you would look at a lot of variables. I think there are three in early stage FinTech, which is what I'm focused on, that I always sort of referred back to. So one is that it needs to be a problem that I understand and recognize. So I struggle to go into something if I don't understand, one, like, what are you actually solving for? And secondly, like, do I recognize this is like a really hard problem? So if I say, oh, I understand what you're doing, but I don't see this as something that is really going to warrant either enterprises or consumers to sort of part with their money or to give you their time or effort because I don't recognize it as a hard enough problem. So I need to have that conviction that like, I know this is a problem, I understand it, and I recognize it's a hard enough problem that needs to be solved. The second one is one that is very common with early stage investment approaches, but allow me to explain. So the team needs to be the right fit for the problem they're solving for. So again, like I revolve a lot of my decisions around problems because I think ultimately that's what businesses are doing in a free market. They're solving problems. So the team needs to be the right fit for the problem they're solving for. Now, I don't get too carried away over sort of call it labels. So I think there's a lot of that in the industry that people think, okay, someone's worked at this company and they're X this and X that. And I think that's important to understand someone's background. I don't get as carried away as that. When I think about, is this the right team to solve this problem? I actually probably think about two things. One is like almost professional ability or almost like the skill and experience they're bringing to the table. So a perfect example of that could be payouts. So Ernst, the founder, it's a marketplace payments platform, and it gets very complex, right? How do you account and consider all the nuances and technicalities of multi-party payments? It's a fantastic startup based in Amsterdam, here where I'm based. And Ernst is someone who was at Adyen before. Ernst is someone that I think has like a really intricate understanding of payments. So if you're presenting really difficult payment problems, you know, regardless that Adyen is a big name or not, like within a conversation, you really understand like if there's someone that has the know-how and foundation to solve tough problems in payments, Ernst is on that list. That's a really good one to say. And Adyen is fantastic. It's a great brand. I mean, it's one of the big European success stories in FinTech. So that's great, but that's like a bonus to me. And then there's a lot of like positives that come with that. You know, Ernst, his experience, building a startup in Amsterdam, having been at Adyen, which has its HQ in Amsterdam, et cetera, et cetera. But I really look for almost like the intellectual fit, like do you have the experience and skill set to solve those problems? The second one is like, so one is like, you know, professional fit. The second is almost like personal fit. Like, why are you doing this? Like beyond, you know, your ability to focus on hard problems and is like, do you have like a little like chip on your shoulder as to why you're doing it? Do you have like something intrinsically within you that if this problem isn't solved, like it pains you? An example of this is I invested in a company in Colombia called Mono. So it's SME banking. And the founder, Solomon, I mean, you know, if you follow him on social media, he's someone that's just like, it hurts him to see small businesses get poor experiences from incumbent banks that are offering SME banking. You know, I really do think if he gets a call tomorrow from a, you know, small business that says, I had to wait 3 hours on customer support, I think his stomach turns upside down. I think he's like, he needs to solve that problem. Like he sees it as like the world isn't like good until this problem is solved. You see that with a lot of founders that, you know, for better or for worse, like might have a point to prove. They might think that, you know, whether it's a chip on their shoulder, whether they just don't agree with it and they're almost like so intellectually addicted to solving this problem. I think that makes like a really special ingredient. So that's two. So that's like, you know, within the having the right team, is it like professionally, but also like personally, a good fit for this. And the last one I think is an obvious one. And I always come back to this, no matter how much I like a founding team or an idea, et cetera, is there needs to be economic upside. You need to look at this and say, okay, this is a business that is going down the venture capital route. Do they have a business model? Are they in a market? Are they solving a problem big enough that there can be dramatic upside over the many years that it takes to build a big business? But I will always come back to that. Even sometimes I'm very excited about the founding team. But if I can't convince myself that either there's a large enough market or that the business model or product can lead to some kind of like unfettered growth, it's usually a no for me. So economic upside. So 3 things. And then there's one thing to note. 1, it needs to be a problem that I understand and recognize. 2, there needs to be a fit between the founders and the problem they're solving. 3, economic upside. Notice I haven't put what the actual product is. Like that's on my list, but it's further down the list. And I'll tell you why. Like when it comes to early stage investing and problem solving, chances are the company will have to pivot. Chances are the founders the first problem they uncover is maybe not the big problem they'll be spending the next 10 years on. So I care more about, is it the right people solving problems in the right space? Because if the space is big enough and the opportunity is big enough and the people behind the wheel are ready or, you know, adequate for the challenge ahead, they might pivot, they might twist and turn, but I still think there's an opportunity or chance to succeed. I really don't get caught up if I try out the demo and I don't love it or I don't see it right away. If I think the space is big enough, if I think the team is right, and I think the problem is there to be solved. So I still care about the product. I'm obviously not blind to it when I read through a deck or when I try a demo, but it's not in my top 3.
So you talked about founders and the why, and I couldn't agree more. Any no-goes?
Yeah, so I think I really try to stay open-minded with this just because I think there's no single profile that leads to success. I think something that's always a bit of a turnoff to me is if I sense a bit too much like opportunism, in the sense that if a space is hot, that people are piling into it. And this kind of relates to what I said is like, then I don't really see that sort of why, like that drive, like the example I gave about Salomon. And so that is a bit of a red flag. That being said, I really try and stay open-minded because I think great businesses are built all kinds of people with all kinds of motivations. And so I try to stay open-minded, but I will say that I have a strong preference towards those sort of 2 traits that I mentioned earlier, which is really like sort of a professional and intellectual fit with the problem that needs to be solved, and also like a deep, like burning desire to solve that problem.
And you mentioned the 12 to 15 companies. Have you put any intentional thought into like portfolio diversification versus also the capacity to support, right? There's always that tension as well.
Absolutely. So I think that's something that I didn't really think about in the earlier stages of my journey, but now I'm thinking about it more. The reason for that is beyond, I think, maybe 8 or 10, if you're doing every month, every second month catch-ups, and if there's follow-up, and if you're trying to contribute, there actually is then a time consideration. And I think it's important that, you won't be able to help every startup with everything, but you should be in a position that if there's something that the founding team knows you can help with, that you're there to support. So in terms of diversification, within FinTech, it's already concentrated. I do try and limit exposure into certain subsectors. So I think, for example, within the world of payment operations, there's, for example, 2 companies that I'm invested in. They're slightly different and serve different markets. But I don't think I would then have a third because I think it would then be too concentrated. Likewise, I think it's important to be very honest with founders to say, hey, I'm looking at another company, maybe not competing with you, but possibly adjacent, maybe different market, but products have overlap. And just be very candid, because what you don't want is a relationship with the founder that might think you're trying to place your finger in too many pies, whatever the expression is. Because I invest in FinTech, it's naturally more concentrated, and I've accepted that. But I also try and limit exposure into different subsectors. I try and be intentional about that. In terms of time spent, I'm actually candid about this, or at least I hope I am, where I often tell people like, what do you need help with? And often it's something, and it ends up being a candid conversation to say, look, I think I can help you with this. Like, I think, right? I'll try my best. Who knows if I can actually be helpful, but I will try my best. And maybe the 1 or 2 other bits, I can be candid and say, I don't think I'm like the best person for that. I've had 1 or 2 deals where after that conversation, it was not sure, we're looking for different angel investors. I think that's fine. I think that's okay. Because I've also had several other ones where they say, look, really appreciate the candor. And that one thing you can help with, we actually really need help with that. Or we might need it in 6 to 12 months. So we want you part of the team. And I think that's an underrated trait. The best angel investors I've sort of interacted with and met over the years are, I think, candid and honest. And I think that leads to a much more productive relationship, whether you will be working with those founders or whether you'll just be interacting as part of a bigger ecosystem over time.
Yeah, absolutely. And I think we've spoken many times about the importance of reputation on this podcast. So absolutely. And it's in the end, the product of what you just said. I'd love to ask you about your international investments, because you've mentioned a few here, and you also started out saying your portfolio is actually quite geographically distributed. You've done deals in both EU, US, Israel. And I'd love to ask you, what is your reflections on the back of that? Why have you chosen to do that? And why haven't you gone for something more geographically focused?
I think opportunity, it sounds cheesy, but opportunity is everywhere. If you look at 20 or 25 years ago, I wasn't an angel investor then, but you might be like absolutely trying to, get to know who's who in the Bay Area and Silicon Valley and say, okay, those are the deals I want to get into. And then, the last 5 or 10 years, you have so many hubs that are churning out talented people and terrific businesses. Granted, it's early stage, so they're risky, but talent and opportunity is everywhere. It's no longer concentrated in 2 or 3 metropolitan hubs. And also, again, it's back to what I said initially. Some of this is sometimes just organic. It's people you meet. For example, I lived in Israel when I was a student, so still have some friends there. And one of the deals was actually through an introduction. So again, a little bit organic as to where an introduction comes from. When I moved to Amsterdam, I kind of met with a few people that are based here. That's actually how I met Ernst at Payout. So it wasn't this intention, like I absolutely need to invest in these X countries, but just the nature of, again, staying open-minded, meeting people, taking the time to just connect as people are introduced to you in the industry, I think has led to that geographic diversification. Unfortunately, it's not a really well thought out plan, Andreas, but I think it's just about what happened.
There's many who have the view that, they want to be able to get on a car or at least a plane and then within an hour or two be by the portfolio companies. That obviously is not your approach. Why don't you really care, about that part?
So look, I think this is one of the luxuries of being an angel investor. I think if you're a VC full-time, it probably is a part of your role to travel, maybe attend board meetings, maybe need to be at certain conferences or events, etc. When you're angel investing, it's very much so something that you're doing that maybe supplements your role or complements your role. But realistically, even if a portfolio company were a 1 hour drive away and wanted to have a board meeting, one, as an angel investor, you maybe don't have the ownership that warrants participation in board events. And secondly, you might not have the time. I think most people know when they're bringing on angel investors, it's not their full-time gig. They have maybe other responsibilities. I've never felt that need. And what I will also say is just the nature of traveling with work, traveling personally, I'm often surprised how often I'm meeting with people in real life. People that are in Amsterdam for a conference, I'm going into London for work, and you say, oh, why don't we just catch up for coffee? So those in-person interactions do still happen, which is why I've never felt like I'm missing out because I'm not within a 1 hour drive or that I can't be within close proximity to a founder.
How many of the investments have you done without ever meeting the founder? Also now afterwards, do you have any in your portfolio that you've had, for the 2 years that you've been investing but haven't yet met?
And just so we're clear, when we say haven't met, so I've met all of them like on Zoom. So let's be clear. You're talking in real life. I'd say probably half and half. I think so. Yeah, I think so. I'd have to write it down, but I think that's
in the neighborhood.
Little mental math. I think it's half and half.
How do you think about that, Anthony, for yourself and Cocoa?
I doubled down on what Dan's saying, right? I think the nature of Cocoa is that we are an angel fund, right? And so we're a bit of a hybrid. We act like an angel on the support side, and we're thought of as an angel, but we kind of have a fund behind us. We are 24/7, though. We are full-time. I think there's nothing that can replace the face-to-face interaction.
Agreed.
Many times that we've done investments that we spend a lot of time before we make an investment, and it's all about the founder, but it might be over Zoom, right? We're also a small fund. We don't have the luxury of like flying here and there everywhere. It's just the two of us. That being said, we do strive to go and meet the founder in the next few months, right? At some point in person after a deal has been done. If we don't manage to meet them prior to an investment, right? I think when the pandemic happened and suddenly everyone crossed the line of like, oh, we can actually make investments virtually, it was a big mindset shift for me personally. At the time, I was a lead VC, and we had a motto like we would never invest. There's also something really nice about like going there, spending time with the founders on a face-to-face, going for a dinner. I think that's all great. As a lead VC, you should still try to do that. I think also mentally, it took a while. I think for me, it was like 6 to 7 months. I hadn't done any deals. I kept like passing on everything because I couldn't develop conviction enough when I was a lead VC at Speed Invest at the time. But I think once you made that shift, analyzing and assessing over Zoom is not the same as in person, but it's very much doable. Now, because we're full-time on it, we'll definitely make sure we meet them in person as well. It's a combo. And I would definitely think that you can do both. I definitely, though, think there's nothing like the face-to-face, right?
Yeah, I agree with that. I think the preference is always to meet people face-to-face, but the reality is that face-to-face meetings aren't sort of as available as you'd like sometimes. So the next best thing is a lot of Zoom calls and Google Hangouts, and seems to be working just about fine. And then over time, you do find a chance to meet with people in person, however you can.
Before we go into our segment about core learnings, I have to ask you just the question about how you interact with the VC ecosystem. Have you done any LP investments? How do you think about all that?
Yeah, so in terms of, I guess those are sort of split that up into two questions. In terms of interacting with the VC ecosystem, I think that's a great way to build out as an angel investor, to build out your network. I think there's a very sort of symbiotic or mutually beneficial relationship between angels and VCs. For obvious reasons, I think angels tend to play a more active role in the early stages of a startup, but then afterwards, the desire is more towards institutional investing as the company grows. And so having those relationships can mean two things. One, it's three things. One, just a great way to build your network. Again, back to what we said earlier. Two, maybe it allows you to be helpful to founders. So if you understand, hey, these are 4 or 5 VCs, I'm regularly in touch with them. I know these 1 or 2 are sort of really specialized in your space. It actually allows you to be a bit more helpful to founders when they start going into their Series A or later rounds to say, look, instead of spring and praying, I think just focus on these 2-3 funds. And again, if the relationship is built, you could maybe help with a warmer intro, but you can also know that like your space is space they're looking at, as opposed to going in blind into different pitches and into the fundraising process. And also, I think it's, in many ways, there's a really helpful like sharing of information that happens between angels and VCs. So VCs might be on top of certain trends or patterns, or see companies that sort of they invested in relatively early stage and then sort of see how they mature into later parts of their growth. And as an angel, like I might not have that visibility because beyond a certain point, institutional investors or VCs play a more important role. So overall, I think it's very beneficial to be investing in those relationships with VCs or with other types of institutional investors that are getting involved at a later stage. In terms of LP investing, to be fair, that's not something I've dabbled in, for a few reasons. One, I think I'm still very much so enjoying building my angel portfolio. And I think that's something that I want to focus on. I think at a later stage, when I've sort of learned more and gathered more about my experience with my own angel portfolio, I would then maybe look into, are there other fund managers? Are there other interesting opportunities there? But unfortunately, to date, I've been more focused on my own direct investments into early stage companies.
You out here learning more about them angels, are you?
So if you had to share 3 with the listeners, 3 core learnings, right, from angel investing, what would those be?
First one, which is a bit of a theme that we've discussed, relationships matter, old ones and new ones. So, you never know when you meet someone if that will just be a friendly coffee or lead to a terrific opportunity. You never know if being that person can then help those around you. So whether it's people you're meeting for the first time or relationships that I've built over the years, they really do matter. Andres, you mentioned this earlier, like reputation is everything. So as you build up those relationships, I think it very much so feeds into your reputation and also your standing, which over time hopefully improves and leads to better outcomes. The second one, which is one I've had to like condition myself, so this is like a real learning, is strong opinions loosely held. So I think in general, like whether you're logging onto an app to buy stock of Amazon or whether you're angel investing, generally speaking, if you're parting with your money or time to invest in something, you need to go in with a certain like level of conviction, right? You need to have like a certain opinion or an idea of like, this is where I think the direction that the world or an industry is heading in. So I think it's important to go into these things with opinions or strong opinions. That being said, if you hold too strongly to them, I think you'll be in a lot of hot water, because this world of high growth investing is based on people just thinking outside, big wins coming from outside the box decisions. So come in with, strong conviction, opinions on, your portfolio should almost be a reflection of the direction in which you think the industry or the world is heading in, right? But at the same time, if you held too closely to those convictions, I think you'll miss out on a lot of great opportunities, because things are always changing. There are always new ways to solve problems, maybe better ways to solve them. And if you're sticking to your convictions too closely, I think you will miss out on some great opportunities. I've had to condition myself to think this way. So definitely a learning. The last one, I would say maybe some basketball fans would appreciate it. Trust the process. And I say that because when you're making early stage investments, it's not like I sign up to a Bloomberg terminal and I get instant feedback on how the company is doing and whether the stock price is going up or down and any major changes. It's very much so something you need to do and accept the reality that it might take a very long time until you see traction. It might take a very long time until you see some of those business metrics appear. There's a natural amount of high risk that's embedded into it all. So I think if it could be a bit scary for people, because you might think, oh, each investment is so risky. But I think if you sort of, like I said, you have your investment approach, you stick to it, no doubt you learn and iterate over time. But if you do this over and over again, I think you eventually build a portfolio where you might have some that do really, really well. You might have some that don't do so well. But over time, I think that process does pay off. Everyone's process is a little bit different. And I'm sure mine will, improve and iterate over time. I certainly hope so. But I think given the long timelines that come with this, it's very important to trust the process. So yeah, those are my 3 learnings.
I'll just double click on the second one. It's also so difficult. A lot of venture investing is about mental models, right? Like pattern recognition and learning what works, what doesn't, what industry, what model. But being humble is also so important at the same time, because you have to be very plastic, right? Like at what level do you keep those mental models? Like at what level are these pattern recognition, these learnings to be kept, right? You can't overgeneralize. How plastic can you be? And there's always this tension between utilizing your past to be better today but actually being very open-minded to morphing your past learnings, right, with today as well.
It's almost this like terrible irony of, to succeed, you really need to be learning from past experiences, but to succeed, you need to be willing to shed off all past experiences. So good luck figuring that out, but it's a very, very delicate balance.
I will now transition into our segment that is called the Quickfire Round. These are quick answer questions, 30, 60 seconds each. Are you ready?
I think so. Let's go.
What's the most counterintuitive thing you've learned since you started angel investing?
I think it's exactly what I just said, which is hold on to your opinions and everything you've learned, but equally be ready to shed them off in a split second.
Second one, what would be your top tips to angels wanting to do more international investments?
Honestly, it's ask around. I think especially more and more, if we take Europe, for example, I think it's really impressive to see how many different hubs have appeared that maybe were significantly smaller only 3 to 5 years ago. And so if you're sort of taking the time to network and meet people, ask around. If you see some interesting trends in the ecosystem in Germany or Berlin or wherever, ask around. I think most connections are 1, 2, I don't even think 3 degrees away, especially if you're already working within the industry.
Final question, and this is a more personal one. What advice would you give your own 10-year younger self if you only had 30 seconds?
Be persistent, but be patient. So, I think hunger is very important, throughout your career, any aspirations that you might have. So stay hungry, stay persistent, keep chasing, but equally be patient. Things take time. You can't necessarily get everything you'd like as a sort of 22 or 23-year-old right away, unfortunately. But also if you keep doing it at the right pace and do it I think, consistently, good things do tend to happen. So be persistent, but be patient. And I'll leave it to my 10-year-old younger self to figure that one out, because it almost kind of doesn't make sense when I say it out loud.
I've always been slightly impatient, but enough where life kind of was telling me, hey, dude, be just a bit more patient, right? So maybe that's the balance. Thanks for joining us, Dan. Thank you. Some great gems.
Yeah, absolutely. No, thank you. My pleasure to be here. Really enjoyed it. And looking forward hopefully to catch up every year or so, and we see how those 3 learnings change over time.
Yes, and we'll come back in 10 years as well and ask you for advice to your 10-year younger self.
Exactly.
Awesome. Thanks so much for joining us, Dan.
Thank you for listening to this week's episode of the Super Angel Podcast, the go-to podcast for angels backing the next generation of European unicorn founders. If you love our show, do drop us a review, share it with your friends, and join our Angel LP syndicate at EU.VC. And if you're an angel listening in and wanting to get closer to the European angel scene, please do not hesitate to reach out to us. We'd love to connect and see how we can play together. And now, some words from our beloved sponsor. Vaban from Qatar is the easiest way to launch and run your syndicate. Vaban's end-to-end platform automates your back office so you can focus on what matters, supporting the next generation of entrepreneurs and building your network. Angel investors are the fuel to innovation, and they've created the Atom SPV to allow for more deals, more ownership, and less fees. Backed by Carter, the leading fintech infrastructure company, Vaban will be with you all from fundraising to exit. Investors on the Vaban platform have raised over $2.5 billion in global investments for companies including Revolut, Bolt, and SpaceX. If you'd like to learn more, please check out www.vaban.io/EUVC.
You've been touched by an angel, girl.